Thank you so much for joining us today, John, for our ESG Investment Influencers interview. I wanted to start by asking you about what's really driven your passion for responsible investing during your career.
I've been doing it for most of my career now, but actually it was a personal interest. I was working for an insurance company many years ago, found it a bit dull, really turning around pieces of paper, and I actually wanted to do something I believed in. So it definitely comes from personal conviction to actually make a difference in the world.
And you must have seen during your career this huge transition, this huge change in attitudes towards responsible investing compared to what we were seeing even just a few years ago.
Absolutely. I mean, I've probably been in this about 30 years now, it's a long time, but it's really only been, I would say, over the last 2 years that there's been a sea change, I think, in attitude and interest in the whole area.
Well, where do you think the industry is on this journey to responsible investing becoming mainstream and sort of truly integrating ESG?
We're still at the early stages, actually, of the whole responsible investing theme. ESG, I think, is here to stay, and I think in terms of ESG integration, I think all funds will have ESG integration at some point, and we're probably not too far off getting to that stage, almost where it's like hygiene, really. So when an investment manager assesses a company, we don't question cash flow modeling or something like that. And I think ESG will be viewed in the same light, really. It's just an extra tool that investors are using.
And maybe you can explain briefly how you've approached this area at Square Mile in terms of integrating ESG considerations into what you do, and also your sort of responsible investment offering.
Okay, so we have a number of ways of looking at funds and companies. And Square Mile started from the premise of looking at ESG integration. So there's an assessment of how well ESG is integrated, both within a firm and within funds. Square Mile also have financial assessments, which they conduct on responsible investment funds, but the focus there is very much on the financial credentials of the fund. I came along with 3D as a separate approach, which looks at responsible investment funds. So those are funds with a specific mandate, a specific responsible investment mandate. And then the 3D process is quite different because it's actually looking at three things, as you might expect from the title. So it's looking at doing good, avoiding harm, and leading change. So everything is assessed through that lens, really. So the 3D ratings are about looking at the overall positive and negative impacts of a fund, as opposed to the financial elements, which is Square Mile's bread and butter.
And that leads us on to ask in a little more detail about the main elements of your due diligence process when speaking to managers about responsible investment. What are really some of the questions you're kind of drilling down to and trying to find out about their portfolios?
Okay, so it's an evidence-based process, so I should really emphasize that. So really what it's looking to do is a fund doing what it says it's doing, and really measuring against this framework that I mentioned just now, so to the extent to which it does do good, avoid harm, and lead change. And in order to assess that, really we look at the fund on a holding by holding basis. So there is a lot of scrutiny of each holding within the portfolio. So we're looking for two things. One is, are there any ethical controversies associated with the portfolio? And secondly, we classify each stock. So is it presenting a solution to a social or environmental challenge? Or does it have a limited positive impact? Or indeed, is it having a negative impact? And we actually categorize those solutions and map them to the UN Sustainable Development Goals. So we can then paint a very clear picture of the fund as to what percentage is invested in each of these areas, what the potential harmful issues might be within the fund. So an investor has a very clear picture of actually what are they doing, what does this fund look like, not just concentrating on process and criteria.
And how do you sort of negotiate the difference that managers have and in definitions around this area? So, for example, what one manager may be happy to have in their responsible investment fund, particular company, and could argue the case for another manager wouldn't hold. How do you kind of negotiate those distinctions?
Okay, well, that's really why we designed the 3D process, because it's a consistent and comparable way of assessing funds. So we have our own classifications, our own way of doing things, and so we'll compare things on a consistent basis, really. So if managers treat things differently, we treat them the same across the funds. So it's a way of comparing what can be very, very different approaches, and as you say, different opinions on funds. So yes, we have a very consistent way of comparing funds.
What are some of the challenges in terms of information in this space? What groups are providing to you, and also, I suppose, in terms of company information that they're providing to you as well?
It can be extremely variable. We ask for information. We issue a questionnaire to each firm. We inform them the sort of things we're looking for, but clearly what's available is very, very different. So some funds, particularly those that are focused on impact, will have a lot of information. They'll have a lot of reports. They will back up their selection stocks with descriptions of the stocks, for example. Other funds may have much more scanty information, or they may use third-party reports rather than producing their own reports. So it is very, very variable. All the legislation that's coming forward is helping address that, because there's some consistency coming through in what firms have to report on. So that will definitely help.
And I know you mentioned earlier in terms of the ESG integration side about the parent company and the sort of credentials there. How does that fit in looking at it in terms of the responsible investment offering? How much are you looking at what the parent group's doing as well as what's happening on the fund?
Well, we actually have two assessments. So we are assessing funds, but we're also assessing the parent company as a separate assessment on the corporate side, because we found that some advisors were actually really interested in what the parent company was doing. Do they actually believe in this or not? So again, we need a way of assessing, getting through the potential greenwashing of it. You know, what are they actually doing on this? And I suppose what we're looking for is some sort of metrics that we can actually assess this on. So there's actually some objective data as well as the subjective assessment of a firm. So we would be looking at things like internal practices. What do the companies themselves do? You know, do they have a policy on their transport, on their energy, their philanthropic activity, and even their company structure? And to what degree are senior management responsible for these issues? How well is all this integrated throughout the company? You know, it's all very well having an independent department for ESG or responsible investment, but what difference does that make to the average fund manager? Who's using it? How well are they using it? Are they required to? Is it reflected in their remuneration policy? These sorts of things. So we'd be looking for hard, granular evidence, I think, on the corporate scale as well.
And are you seeing quite a mixed picture at the moment in terms of what certain groups are doing? And they may have a very good suite of funds that are meeting all the requirements, but at a parent level, they may be not, and maybe vice versa?
Yes, that's certainly true. I think the leading funds are generally the parent company would see an opportunity there and therefore would try to get its own house in order, but there still is a lot of variability, certainly.
And there's been a lot of discussion around ratings agencies recently in light of the whole huge transformation of this area. And obviously discussion around there can be often different results in terms of the ratings that are given, which can be quite confusing for investors. How would you sort of respond to that? And how do you think this sort of part of the industry will evolve?
I actually think it's quite good to have variability, because if we just have one standard, is that the right standard? But I think the key issue here is what are those scores? What are those ESG scores, the ratings, being used for? You know, it's okay if they're an input, which is then considered, but as an output, it's not always a very good output. So if you just see something, the raw data, without any explanation, without any understanding of the assumptions that come up with that score, then I think there's a real issue, because who knows whether a score of 67 versus a score of 35. It all depends on the assumptions. And the problem is that unless you're really involved in the whole process, how do you know how to interrogate those numbers? Who's right? That's the real difficulty. So I think there has to be a big degree of transparency in terms of understanding these scores and where they're coming from, and then applying them rather than just throwing out a score.
And I suppose from your side, being very clear as to your assessment process and what's involved in that and what you're looking for within that, so they can use that information as part of their wider.
Absolutely. It's really important to understand the assumptions. It's very easy to produce a nice pie chart or bar chart to represent something, and who knows whether mine's right or somebody else is right. Understanding where that data comes from is absolutely crucial.
And I wanted to ask you about where you see the big opportunities for investors in terms of responsible investment portfolios. What's really exciting you about what's happening in the industry at the moment?
No, I think it's on the thematic side, the impact side, definitely. So I can actually see some really multi-decade opportunities coming through. So it'll be no great surprise, but it's in the areas of clean energy, electrification, healthcare, some of the IT opportunities with an environmental impact as well. All those things are things that are not going to go away anytime soon. They're going to be with us for a long time. And they are presenting some very major opportunities, I think. Probably the best opportunities in the whole investment market, I would contend.
And just on the other side of that, where do you think that sort of the gaps are in terms of maybe product development in this area, or areas that you think have been maybe a little bit overlooked so far?
Yes, well, I think the focus has been on the environmental side. So I think the social side probably needs to go through a bit of a process of catch up in some areas. So, for example, we've seen green bonds emerge, but social bonds are a bit behind that. There are also, I think in the ETF market, it's still, has got a long way to go in terms of its, by its very structure, it's rules based, but I think you can introduce nuances to it. There's actually some funds which are introducing some engagement to the whole process, and I think we'll see more innovation in that sort of area. Then there are very specific funds, maybe, where there are gaps. So as the whole area becomes more sophisticated, probably managers, rather than just choosing a global fund, might look to get exposure to particular markets, let's say Japan, for example, or to a particular asset class. So instead of just getting bond exposure, maybe they want high yield or with a sustainable options. Now, at the moment, all that's quite relatively limited, but I could see that really expanding at quite a rate.
And what would you like to see now from the industry in terms of the evolution of responsible investing? What do we really now need to do as an industry as this moves forward?
Having more consistency in definitions, I think, would definitely help. There's still confusion despite all the attempts to actually reduce that confusion. Education process, I think advisors as a whole, there's still a lot of, it's a complex market, so it's understandable, but I think we're still at an early stage. So there needs to be a lot of education about the different approaches, what might be suitable for certain clients, about how you actually approach clients on this subject. Needs to be a whole lot more done there to really advance the whole industry. So I think the other area which could be advanced by the industry is the responsible investment reporting. That's going to increase over time, both in its sophistication and its scope, probably. So we mentioned the data already. The data will improve a lot, and that will enable us to produce more consistent reports. And actually, I'd like to see the stage where we get the same sort of reporting on responsible investment as we do on financial reporting. So, for example, in the fact sheet, you'll see a makeup of the portfolio. I would hope on every single fund we would have some responsible investment metrics that are included in every fact sheet. So on every fund, not just a responsible investment fund.
Yes, that'd be really interesting to see how that develops as the industry evolves, and at what point we get to that. It seems like it's definitely coming. Well, thank you so much for your time there, John. It was great to get your insight into what's happening at this really exciting time for this area. So thanks again.
Thank you.